Malaysia's oil and gas journey, which began with a discovery in Miri Sarawak, 1911, has evolved into a foundation of its modern economy. Today, the nation has transformed from a raw material exporter into a global competitor in petroleum manufacturing, specializing in refining crude oil and producing high-value petrochemicals goods. This strategic shift is clearly reflected in the numbers. Under the NIMP 2030 plan, the sector's economic contribution surged from 35.3 billion ringgit to 41.9 billion ringgit between 2020 and 2022, while exports of petroleum-based goods reached a remarkable 143 billion ringgit in 2023. Led by Petronas, with its network of major refineries across the country, this thriving industry continues to drive economic growth, create skilled jobs, and solidify Malaysia's strong positions in the international market.
Malaysia mainly export refined petroleum products which have a higher market value compared to raw crude oil. These include petrol for vehicle, diesel for transportation and machinery, jet fuel for the aviation industry, liquefied natural gas for the power generation, and naphtha which is used to produce plastic and fertilizer. By exporting refined products, Malaysia moved up the value chain and increased its revenue. Next, the manufacturing process began with separation of distillation. Crude oil is heated about 400 degrees Celsius and enters a distillation column. Light product like gasoline rise up to the top, middle product like a diesel stay in the middle, and heavier product remain at the bottom. The second stage is conversion, which include cracker and reforming. Heavy molecules are broken down into lighter one to meet the higher demand for product like gasoline and jet fuel. Reforming also improves the quality of this fuel. Then, in the treating and blending stage, impurities such as sulfur are removed and the products are blended to meet standard like Euro 5. Finally, all finished fuel are stored in tank and exported through major port.
Malaysia remains a major oil and gas exporting nation in Southeast Asia. In 2024, Malaysia exported more than $25.7 billion worth of refined petroleum products. Those refined products exported in 2024 amounted to around 37.8 billion kg of oil. The top destination country included Singapore with $6.11 billion, Indonesia $4.79 billion, and Australia $4.35 billion. From here, we can see that Singapore plays a very important role, not only as a buyer but also as a regional trading and export hub. That means a substantial portion of Malaysian refined oil is shipped there for blending, bunkering, or onwards resale. At the same time, demand from Indonesia, Australia, and other regional neighbors remains strong, underlying Malaysia's strategic position in regional energy supply. With this consistent strong export and diversified destination, Malaysia has opportunity to expand high-value downstream products such as petrochemicals and specialty fuels rather than just bulk fuels. In short, Malaysia's petroleum export market remains robust, with refined products as a major export pillar.
In the past few years, Malaysia's export earnings follow a clear trend. During COVID-19 in 2020, the world slowed down, people stayed home, and fuel use dropped. At the same time, Brent crude oil fell to around $41 per barrel. But when countries reopened in 2021, fuel demand increased again and Brent rose to about $70.9 which helped Malaysia export revenue recover. The best performance was in 2022 and early 2023 when Brent reached an average of USD 101.3 per barrel. Global refineries could not produce enough fuel, so price went up and Malaysia earned more. After late 2023, Brent dropped to around USD 82.6 and some months showed lower export earnings. More recent data shows that Brent was around USD 73.23 in December 2024, USD 69.85 in mid-2025 and USD 63 to 64 at the end of 2025. This shows how unstable prices are. When crude price go up, refineries pay more for raw material. Their profit depends on whether petrol and diesel price rise at the same speed. If not, their margin becomes smaller. Crude price also affect Malaysia's trade balance because we earn US dollars from petroleum exports. High price strengthen our trade position, while low price reduce export earnings. In short, global oil price influence Malaysia's downstream industry through production cost, selling price, and exchange rate. And this factor decide how much the petroleum sector can support our economy.
First, the principle of supply and demand explain oil price volatility. Global crude oil price change based on world supply and demand condition. When crude price rise faster than refined fuel price, refinery profit margin shrink because production costs increase, while selling price remain relatively rigid. Oil price volatility can be explained by supply and demand curve. When oil supply decreases due to factors such as geopolitical conflict or production cuts, the supply curve shifts to the left, causing price to rise. While when global demand decreases due to economic slowdown, the demand curve shifts to the left, leading to a fall in oil price. Next, fuel subsidies such as BEEB1013 relate to government intervention and market distortion. While subsidies make fuel more affordable and protect consumers in the short run, they can lead to overconsumption and long-term fiscal strain. Lastly, comparative advantage and competition help explain Malaysia's position relative to Singapore. Singapore has invested heavily in technology and automation, lowering its average cost of production and increased productivity. This gives Singapore more competitive advantage, forcing Malaysia to improve efficiency through digitalization and AI adoption.
To sum up, Malaysia's petroleum business has successfully grown into a significant economic activity, impacting export earnings and making the country one of the leading producers of high-value fuel products, assisted by infrastructure such as the Pengerang Integrated Complex. However, the future of the industry is still exposed to various economic risks. For example, fluctuating global Brent crude oil prices, intense domestic regional competition requiring efficiency in operations, and long-term financial pressures due to the domestic fuel subsidy system scheme called BEEB1013. To overcome these obstacles and achieve lasting success, the industry needs to adopt a critical two-pronged approach, namely digitalization and ESG compliance. Through the use of artificial intelligence and IoT to achieve smart operations and predictive maintenance, one can achieve maximum efficiency. At the same time, it is important to make significant strategic investments in the CCUS framework and the circular economy to address global ESG demands and achieve carbon neutrality. In addition, revenue diversification with a continued emphasis on high-value petrochemicals and polymers will offer the necessary shock absorbers against market variation. Finally, with a focus on high-tech products, a commitment to environmental needs, and a diversified portfolio, Malaysia can become a strong, competitive, and sustainable power that will be able to sustain the country's economic development in the future.